All right, this is Greg Vincent. I'm at the marketing rally here for Farm Journal Media, talking to Dan Bassey with Ag Resources. And Dan, you just gave your presentation here, and you covered quite a few topics, but just a couple of the key things that I want to hit on is we talked some about the economic recovery and the money, where that's really filtering to, and how that's really maybe not helping the economy as much. Let's talk a little bit about what you were explaining there.
Yeah, the big problem is that a lot of the funding that the U.S. government has provided under TARP and other programs has gone directly to the banks. The banks are able to borrow from that facility and of course through Fed funds at a 0 to a quarter% rate. A lot of times we call it free money because there's virtually no cost to it. But the banks, rather than allowing that to filter down into the common man, have been investing it in the markets. They've been buying stocks. They've been buying U.S. 10-year treasuries at 3.5%. And so they're willing to make 3.5% on billions of dollars, which is why the overall markets have been doing so well. So a lot of the rally in stocks, a lot of the rally in commodities, and to a lesser degree has been really related to the investment flow from banks. Unfortunately, the common man, the loans to consumers and small businesses have been in a decline, and that's where our economy is stumbling and why our unemployment rate keeps rising.
Now, but some of that's filtering back into the commodity money, so it's maybe a little beneficial to some farmers, right?
No, absolutely. The farm community is beneficial because I don't think we'd have $4 corn or nearly $11 beans or $6 wheat without that speculative flow of funds.
So if we see some interest rates coming back up, is that going to be a negative?
It will be a negative because a lot of people will start to pull the money out of their investments. They'll start the deleveraging process again, and so we're getting into a big economic cycle of run-ups and run-downs, and the question for producers is just being positioned at the right time.
Now then, not to focus too much on the negative here, but some potential for some more money coming out of the market is position limits. You're looking at something happening maybe fairly soon on that.
Yeah, the CFTC has of course been studying the issue of position limits in terms of what they should be and where they should be placed in metals and energies. I think in the grain markets, position limits will stay the same, but they may be more arduous in their scrutiny of who actually controls what. And so if a big bank only has 22,000 contracts of corn exposure, they may have to sell out some portion of their position, and that would have a negative connotation on the short-term market. So we're watching for legislation, regulation, if you will, from the CFTC. When and where is always the big question. They told us sometime in late fall, early winter. We'll see how that all bears out.
And that, but how significant could that be to prices?
Oh, it could be very significant. If everybody has to fit through a small hole in the door at the same time, we could see a cascading of prices for a very short period of time as speculators reduce their exposure. At this point, it's a little hard to speculate on exactly how much and how far. We just don't know what the legislation will show.
You talked about then the bull leader for 2010 that you're looking at is corn. That may run a little bit contrary to some of the things we're seeing here in the U.S., but looking at it globally, what are you seeing that makes that?
Well, the big thing that's occurring globally is that the biofuel story is still well and alive. We, of course, see it slowing down a little here in the United States, but in terms of biofuel use in China and to a lesser degree Europe, it's still kicking along quite nicely. We think that if crude oil prices stay high or rally closer to $90 a barrel, that it will be a catalyst. And so if I look at the global landscape, the world's going to consume about 800 million metric tons of corn next year. That will be less than our productive capacity that we foresee coming in now, so global corn stocks will drop. That sets up the bullish landscape for corn, irrespective of the extra supply in both wheat and soybeans.
Okay, now today we just obviously did the big round table and to focus a little bit more back on marketing rally and what the farmers might be able to take away from this. One of the things that struck me is there were 15 of you up there and there were 15 very different opinions. So if you're talking to a farmer about looking at who they're going to work with and what kind of analyst and broker they might want to work with, what kind of things would you tell them to really look for?
I tell them to look for people that are conservative. I think one of the themes we've got to have in these markets is going to be extreme volatility. So make sure you're not getting yourself in trouble, either with the banker or your wife. Look at the cash markets a lot of times where there's not margin requirements. I think we have to be careful. The other thing you have to think about is that the market's going to give you several opportunities every year to sell the crop. It's not only one shot with a drought. It's going to be several opportunities where funds come in and buy or sell, and so you don't need to sell everything in one day. You can do it in parcels, and so selectively work yourself into a sales program that you like.
And so maybe with the volatility, we're going to have a few more than just one or two chances even. Or that.
Oh, we may have multiple chances. I don't think a lot of people thought last summer when we had corn at $3 a bushel that we'd ever make it back to $4 again. Yet here with a record crop, we're now trading at $4 a bushel spot futures, and we have new crop at $4.50. Kind of a surprise to many of the analytical community.
All right, that's Dan Bassey with Ag Resources. Thank you, Dan.
You're welcome.